it wants to go to 50. I think there's issues with I think there's issues with it. And I think people in the know realize there's issues with it. It's been managed too much for too long. $50, then you probably blow that out and do, I don't know what happens after that. I don't think it matters too much. I do think, $50 will be better than 38. I mean, I think, people then say, well, where will it go after that? I have no idea. I mean, at some point it will go higher than that. But I mean, right now, the way it looks is that like there's something wrong with it. There's something wrong with the trade that's kept it down. And so that's going to break. And it's like it'll go to 50.
Investor and author EBTucker says when silver eventually breaks through the $50 mark, it will follow a familiar pattern. Traders will try to play the move with leverage, only to be caught off guard by a sharp pullback. Then, when silver finally rips past $50 for real, those same people will say, "I knew it was going to happen." According to Tucker, this happens every time. Silver made headlines last week, touching $39.12, its highest level since 2021, before easing slightly to $38.30. The metal rallied more than 8% in just 5 days, fueled by intensifying supply deficits and surging industrial demand, particularly from the rapidly expanding solar sector. Wisdom Tree strategist says the market isn't just riding speculative momentum. Silver's fundamentals remain firm. We're seeing strong demand in clean tech, while mining output hasn't caught up, he explained. These growing supply-demand imbalances are attracting attention from institutional investors, especially as silver positions itself as a more accessible alternative to gold. As prices climb to levels not seen in nearly 14 years, investors aren't just buying bars, they're also pouring capital into silver ETFs at a record pace. This shift signals a broader reallocation driven not just by price action, but by structural changes in the market. With physical supply tightening and gold becoming increasingly expensive, silver, often dubbed the poor man's gold, is experiencing a surge in demand that appears far more strategic than speculative. Tucker notes that, despite the recent gains, silver at $38 and gold at $3,345 remain significantly undervalued, considering the macroeconomic backdrop. But he warns that the precious metals market remains trapped in a hyper-financialized system, one that doesn't reward still capital and is obsessed with turning every asset into a trade. In such an environment, the real value of metals often gets overlooked until it's too late. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It wants to go to 50. I think there's issues with it. And I think people in the know realize there's issues with it. It's been managed too much for too long. $50, then you probably blow that out and do, I don't know what happens after that. I don't think it matters too much. I mean, the silver bugs are like hard to deal with because they are really excited about this $50, but it's like 33%. I mean, you just said yourself, the S&P's up 25% in like a matter of weeks. My philosophy is I've got a bunch of silver. I probably wouldn't buy it again. It takes way too much space. I mean, like I have more than my body weight of silver and it's impossible to even keep tabs of it. I mean, I don't even think anyone will steal it because it's too hard to carry. It's nice to have a little bit. I do think, $50 will be better than 38. You don't really have many silver mining companies anymore. Like, I mean, there's a few, but like, there's not enough to have a conference. Put it to you like that. You wouldn't even fill the Ramada banquet room. I know most of them. I like them. I mean, I think like it's a tough business. You got to wonder like why they're in it. Honestly, I mean, if they had invented an app or something, they would have made enough money to, to buy their own silver mine, I guess, and fulfill that fantasy. But I have it. I own it. I'm not really going to do much with it at 50. I mean, I think, people then say, well, where will it go after that? I have no idea. I mean, at some point it will go higher than that. But I mean, right now, the way it looks is that like there's something wrong with it. There's something wrong with the trade that's kept it down. And so that's going to break. And it's like it'll go to 50. I guess if you want to trade the futures market and try to play that, Godspeed. You can take it away. Like the futures market is hard because when you trade futures effectively, you totally lose your longer term focus. And then at the end of that, you just have a lot of gray hair and you have stories for people. And I know I've done it myself. I've done it in metals. I've done it in bonds, which if you are short on entertainment, trade bond futures. I promise you, it'll cure your need for entertainment in a hurry. And it's really hard. Like that's why with Bitcoin, for example, I'm much more interested in owning Bitcoin and have been since 2023 than trading Bitcoin. Because when you have something that's moving and you just own it, you tend to do better than you have something that you're constantly nitpicking to death. Because what's going to happen on this $50 move is that you're going to start moving and you're going to amp up your leverage, and there's going to be a quick blowout. It won't last long, and then you're going to be gone, and then it's going to make the move. And you're going to say, I knew it. I knew it was going to go to 50. Did you have any? Unfortunately, no, I don't. So my philosophy is the silver pile is finally going to be worth a little bit more. And
So
that'll be
going,
great. It'll be great.
yeah, let's hope it gets there because people are
I
going to
think it'll
lose their
get there.
minds.
I mean, today it's 38.28 right now. And gold's 33.45. I mean, it's still too cheap. And it's trapped in this like overly financialized world that we're in. That's the problem. I have it on good authority, and this is in a barroom conversation, that the silver people, the Wall Street silver people, almost broke the silver market in 2020. I have it on like out of the mouth of someone that was like soiling themselves at a desk, at a major bank, that was like, I don't know what's going on Reddit, but we're about to have like a huge problem. Remember that? Do you remember that? People were saying like take possession, and people did. I mean, they bought like in serious quantity. That's something to think about. Think about that. I mean, like if everybody really actually, took the silver, there would be a big problem, because none of the banks actually want to hold the silver. That's the problem, is that in this financialized world, what you do is you hypothecate everything. Do you see how it goes? Like every single thing, you have to turn a few basis points on every single asset. You have to do that, or else you have dead capital. But see, for me and you, it's like, what's the problem with dead capital? Like, it's like Bitcoin. Like, what's the problem sitting on the Bitcoin on a thumb drive when it goes from 30,000 to 121,800? Is it really going to kill you to sit on that? Is it really going to kill you to not generate basis points on that? Is this really so? This is a kilogram gold. Is this really so painful to use as a paperweight for couple of years when it goes from 1,500 to 3,400? Is that really going to kill you? To the bank, the answer is yes. To me, the answer is, I think I'll just live with that. Okay, I'll just live with it. And in fact, I think I'll add to it. Here's the coins from the scummy dealer. Like let's just keep stacking. When something's moving, like get in there and make it bigger.
EBTucker says gold miners are finally beginning to outperform, but not to the degree one might expect if the traditional idea of operating leverage were honestly in effect. The outperformance isn't drastic, it's just okay. Historically, the expectation has been that when gold prices rise, miners, with their fixed costs, should see outsized gains. In both 2023 and 2024, whenever gold prices drifted sideways without much momentum, gold equities tended to suffer sharp declines. This drop in performance coincided with waning investor interest in the metal, as reflected by steady outflows from gold bullion ETFs. The relationship between sluggish price action and investor disinterest created a challenging environment for the sector. However, it's encouraging to see gold equities outperforming the metal since mid-April, despite gold itself remaining relatively flat. After a strong first quarter rally, gold has stabilized, trading in a range around $3,300 per ounce. During this consolidation phase, gold mining stocks have regained momentum, delivering significantly stronger returns than the metal itself. The sector has already returned 50% so far this year, far exceeding gold's 26% gain. Despite these impressive numbers, many fund managers still view gold miners as undervalued. Institutional investors remain hesitant, avoiding the sector entirely. Tucker notes the irony. Institutions don't want anything to do with it. They'll pour billions into high-risk junk bonds and speculative garbage, but won't touch a gold miner that makes money. This disconnect between value and capital allocation persists, continuing to shape sentiment in the sector, even as performance improves. Let's get back to the interview.
I'm just looking here because because to give you some data, the GDXJ is up 62% this year so far, and gold's up 28%. This is this year, and you were saying last year, which of course we don't have to go into. Like last year, definitely the miners didn't behave. This year, So with GDXJ, you've performed twice as well. Okay, but the old thing was you get operating leverage to the rising gold price, and it means that you do drastically better. And I just don't think you've done drastically better. I mean, it's like the industry is unfinanceable, so it has no access to institutional capital. Of course, the management of these companies will be emailing me to argue this, but we have this infinite pool of money now, trillions and trillions of dollars. We have like massive amounts of demand for high risk bonds, risky deals, risky funds. And then here's the gold guys are unleveraged, fighting it out in jungle warfare, like bringing this gold back into a highly financialized market. Now they're getting $3,400 an ounce for 33 and a half. I mean, they were getting substantially under what was. I've explained this in the newsletter, by the way. It's like it's a massively liquid market, and so you can move the price around using futures. It's very easy to do. So I mean, it's if you give me a desk, okay, at the Fed, and you say make the gold price 3,000, I'm going to say how much credit do I have? And they're going to say as much as you want. I would say okay, give me like 2 weeks, I'll make it 3,000. So like basically, it's pretty easy to do. And why would you want to do that? Well, because the last thing you want is a blowout gold price that like goes totally bananas. I mean, it makes people like lose faith in saving up money to go to the Coldplay concert. All right. So we need to keep all this glued together. But I think in the newsletter, we own 2 miners. They've done okay. I think they'll do a little better. It's not 2 tiny miners that we think are going to find something. It's not juniors we think are going to get bought. It's 2 highly respectable miners that make money that are kind of like the new blue chips. Do you notice how like the old blue chips, I'm not going to name names because I know the people that run them, are not really the blue chips anymore. They haven't really done what you would have expected in a previous generation. There's new blue chips, and I think you want to own those new blue chips. It's the same with tech. It's the same with any industry. Like buying what was well managed in the last rally is not a good strategy. I'll tell you what else is not a good strategy is coming up to me at a conference and saying, you liked this stock 9 years ago. Why don't you like it now? Well, that's pretty obvious. And if you read my newsletter, you would know. But things change, just like the gold dealer. They change. And my job, this is the way I see it. My job is when the facts change, I need to change with them. Like the faster I can do that, the more successful I'm going to be. Standing around and demanding that Sears come back into business to fix my washing machine from the 70s is not a good strategy. It's a strategy is to say that game's over. Figure it out and do it fast. And when you do that, your eyes open to the new opportunity. And when you see the new opportunity, you outpace people. And next thing you know, you're in the green room with Coldplay getting, they're asking you, how'd you do it? I look at everything in percentages, like a pie chart. So I decided a long time ago, I thought it would be a good idea to have X% gold. That means when I had $1,000 come in from some sort of extra bonus or something, I would take X% and buy gold. Now, these days, I think it's good to have X% Bitcoin, not, pancake coin, not crazy coin, not Trump coin, Bitcoin. That's just me. And so if I have $1,000 come in today or $100,000, whatever, things get lumpy. Like you have something sells and you get like 500 grand. What are you going to do? Split it between your pie chart. So X% is in real estate, X% is in stocks, and X% is in Bitcoin, X% in gold. So I've always tried to keep that percent number for gold. That means, as I grow, I keep that percent. I don't worry about the price so much. Now, if gold has shot to a place where I think it's kind of goofy, maybe I'm going to wait on that. So I might take the money for the gold and put it to the side and be like, I don't know about this right now or something. So that's called being prudent, but I'm not going to not buy the gold. So some dealers change ownership or like partners change or something. And I have one dealer that's super disappointing. I'm talking about it in the newsletter so people can kind of go there if they want to see which one it is. I'm saying the name, but I've dealt with them since 2008 and I don't know what's happened, but they've now, I'm waiting on a shipment of 20 Eagles and Krugerrands that I placed April 20th. I'm still waiting for the final 25% of the order. It's bizarre. They've shipped it in tiny increments. They've been impossible to get a hold of. This is people that I must have spent. It's hard for me to calculate what I've spent, but inevitably I didn't do business with them for like 2 years, probably. I mean, I'm busy. I did business with another guy, and then he was on a diving trip, and I couldn't get a hold of him, and so I called them. And yeah, sure. So I placed the order, and no coins. Things change. Things change. I mean, if you have an experience at a store, and then 20 years later you're back at the same store, maybe the owner sold it to private equity or something, and it's a miserable experience. So that's my point. So that's why I can't buy from the Mint directly. I do like the Royal Canadian bars. I'm not crazy about the maple coins. I mean, they're super nice. They're the highest purity, of course, as you know. So they're great to own, and they're cheap, by the way. Like they don't trade for much over gold. You can almost get them for like no premium, but they're soft. So like if you bang something into them, so anyway, I have my preferences.
Forget the flashy headlines. Absolute conviction in precious metals is often tested in the quiet stretches between price surges. Silver may be making noise now, but history suggests most traders will still miss the move when it matters most. Meanwhile, gold miners are delivering returns that few seem willing to acknowledge, let alone chase. This isn't just a moment for technical setups. It's a test of patience and perspective in a market that punishes hesitation and rewards those who are prepared. As capital continues to chase volatility elsewhere, metals and miners are quietly building a case that's as fundamental as it is contrarian. Will institutional investors eventually catch up to the value hiding in plain sight, or will they once again arrive too late, chasing the aftermath of another historic breakout? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.